In this section, we're going to dig into preferred stock again. We're going to go a little bit deeper. The last time we talked about preferred stock, we were providing an overview, mostly talking about valuation and various formulas that will kind of come up in determining valuation, stock price, the amount of shares that an investor is going to receive, and the price per share that they're going to pay for those shares. So in this section, we're going to cover terms that are indirectly impact valuation or economic rights, as well as some other economic terms associated with price round and more specifically preferred stock. So where we kind of left off last time was discussing the option pool, which really the option pool is very important. We've talked about this from one of the earliest sections that we had on employee equity and developing an option pool to incentivize employees to retain talent and retain talent, right? Kind of building a culture around ownership, right? And that's something that investors understand. They know that one of the best ways to incentivize a growing team is to give out equity, so that way everybody's aligned in their incentives. But also, investors want to kind of have their cake and eat it too, understandably. They don't want to be diluted by the later issuance of stock options or restricted stock to employees. So in a way, they use the option pool prior to their investment as a tool to kind of minimize their dilution after the investment. So importantly, the investors are going to require the stock option pool to either be created or increased and included in the fully diluted capitalization on a pre-money basis, meaning before they make their investment. What this does, as we saw this a bit in the last section, we're going to explore it a bit more detail here, is that it lowers the price per share by investors, right? The price per share is determined by looking at the number of fully diluted capitalization that's existing before the investment. And so by increasing the number of shares, the investors can pay a lower price. And so that investment will in turn buy more shares. So let's take a look at an example here. If WeWash does not have a stock option pool prior to the investment, the fully diluted capitalization is 2 million shares. Remember, Adam and Betty each own 1 million shares. There's no stock option pool, so the $2 million investment buys tag 500,000 shares. The 500,000 shares of the now total 2.5 million shares, being 2 million owned by Adam and Betty and 500,000 owned by Tag, is 20% of the company. Let's take a look at another example here where Tag requires the stock option pool to be included prior to their investment. So it's included in the fully diluted capitalization, which is now 2.5 million shares, 2 million shares by Adam and Betty, and the 500,000 shares that are reserved. And it's important to note this. Reservation of shares under the stock pool is included in the fully diluted capitalization. That doesn't mean that all of those shares have been issued to employees. They're just reserved. So they're going to be included in the fully diluted capitalization based on the fact that they've been reserved for employees in the future. So now we take a look at what we have in this example. That $2 million investment buys Tag Ventures 625,000 shares. 625,000 shares of the now total 3,125,000 is 20%. That 3,125,000 is a product of the $500,000 share stock pool, the 625,000 preferred shares, and the 2 million founder shares. So what happened? In example one, that $2 million investment bought Tag 500,000 shares, which was 20%, right? In example two, that $2 million investment bought Tag 625,000 shares, and still they received 20%. Well, let's take a look at a cap table to see kind of what exactly happened. If you take a look at the cap table, you'll see that Adam and Betty own their 1 million shares. We have the stock option pool of 500,000 shares, and then we have Tag Ventures is 625,000 shares. So if you take a look at the fully diluted capitalization, you'll see that the 16% created by the option pool came out of 8% from Adam and Betty each. They were diluted by the option pool, not Tag Ventures. Why? Because it was included in the fully diluted capitalization before Tag Ventures invested. What does that do? Well, ultimately, the stock pool is used as a way to negotiate price and in turn, valuation. So the founders are kind of in a tough spot here. Everyone agrees that it's important for the company to have a stock option pool, right? To give the employees stock, to incentivize them, to help them retain and bring in top talent. But what are they supposed to do? They're feeling this dilution. So the founders are kind of in a tough spot. And so the best approach is to negotiate with the investors to either, A, decrease the size of the option pool. In our example, that was 16%. Maybe they asked for something along the lines of 10 or 12%. Or B, try to increase the valuation. Maybe they try to get a higher valuation based on, factoring in the decrease of the option pool. So the stock option pool, again, is a way for the investors to indirectly negotiate price. So it's something to consider when you're looking at a term sheet is how big will the stock option pool be? Another aspect of an economic term that an investor is going to require in a preferred stock round is what's called a liquidation preference. A liquidation preference is a debt-like feature that's associated with preferred stock. Again, preferred stock is like common stock, but it comes with additional and special rights. And a liquidation preference is a very important special right that an investor expects to receive. It basically allows them the ability upon dissolution or sale or some type of exit event to be able to ask for their money back first, either first or only, or type of a situation. And this liquidation preference might be tied to multiples. So it might be a 1x liquidation preference, which is the most common, or a 2x, or even on later stage in distressed transactions, maybe a 5x liquidation preference. So there's two flavors of liquidation preferences: a non-participating liquidation preference and a participating liquidation preference. A non-participating liquidation preference, the investor must choose between receiving its liquidation preference back, its investment amount times its multiple, or converting its preferred stock into common stock and receiving its pro rata, its percentage ownership from the deal. We'll look at this in the context example in a second, but let's look at our participating liquidation preference, which is often associated with a double dip. So in this situation, the investor not only receives its liquidation preference, its investment amount times its multiple, it also receives that first, and then it receives its pro rata portion of the remainder after it receives its liquidation preference back. So let's take a look at an example here where Tag Ventures has a 1x non-participating liquidation preference, which is the most common, on its $2 million investment and owns 20% of WeWash. Situation number one, WeWash sells for $8 million. In this situation, Tag's not going to want to take 20% of $8 million. It's going to want to take its liquidation preference of $2 million back because it will receive more. Let's say WeWash sells for $40 million. In this situation, Tag would want to convert into common stock and take its pro rata portion of the 20% of the ultimate $40 million sale price, which is $8 million. Let's take a look at another example, but this time with a participating liquidation preference. Again, a double dip as it's known to be called, known to be associated with. So in this situation, Tag Ventures has a 1x participating liquidation preference on its $2 million investment and owns 20%. Say WeWash sells for $8 million. Tag receives $3.2 million. $2 million, its original investment amount. Then it receives its pro rata 20% of the remaining $6 million, which is $1.2 million. That's pretty good. That's a much better deal than what they received when they had a non-participating liquidation preference. Let's look at another example where WeWash sells for $40 million. In that situation, Tag receives $9.6 million. Initially, it's $2 million back, its investment amount, and then it receives its pro rata percentage based on the remainder of that $38 million left over, which is $7.6 million. So as you can see here, there's a drastic difference when you have a non-participating versus a participating liquidation preference. When you add in the multiples, the difference can either get much greater. The third term that we're going to talk about as far as economic rights that you receive with preferred stock or that investors negotiate with preferred stock is anti-dilution protection. So this is going to come up in a very particular situation. And when we've been talking about raising capital and the life cycle of a business, we've always been assuming that the business is always going to raise funds at an increasing valuation every time. At every stage, it's going to increase its valuation. But that's actually not the case. That's just a goal. That's just an expectation that the founders have and that the investors have. In fact, a company might sell shares at a price per share lower in a later round than it's sold in an earlier round. And so what will have to happen is those investors that invested in the earlier round are going to want to adjust the conversion price, the price in which their shares their preferred stock can convert into common stock. And so the idea is that they shouldn't have to feel this additional dilution because the company raised a down round financing, and that their conversion price should be adjusted. Well, there's two ways to adjust this conversion price. There's what's called a broad-based weighted average, which accounts for the magnitude of the dissolution. So if the later round wasn't that big of a round, or not very many stock was sold at that round, we shouldn't have this huge adjustment in the conversion price. It should take into account the magnitude. And this magnitude is determined based on a formula. The second version of an anti-dilution protection is called a full ratchet. This is unforgiving. It basically says whatever the price per share was in that later down round financing, we'll convert and change the price of the price per share of that earlier round to account for to be exactly the same as that later round. So even if there was one share sold at a low price, it will change the price per share that those earlier investors will convert at. It's unforgiving. It does not account for the magnitude. The last aspect that we're going to talk about a preferred stock round and a price round is the vesting reset. So often we've talked about earlier that the founders will have a vesting schedule, right? A 4-year vesting period with a 1-year cliff. Well, it might be year 2 or year 3 at the time that they raise a preferred stock round. And so those investors will be like, hey, it's great that you have been around for 3 years and have grown the business, but we don't want to invest unless we believe that you're still going to be incentivized to carry on. So we might want to reset your vesting schedule. So is this a negotiation point on whether this will be full? Will they go all the way back to 4 years? Will maybe it just add a year? What will be the terms of that? So the concept is that the investors want the founders to stay incentivized and to stay vested in the business by resetting their vesting. Again, when we talked about vesting earlier, we talked about a single trigger acceleration versus a double trigger acceleration. This might be something that also might be renegotiated when a preferred stock investor comes. Again, acceleration is the concept that if a company sells and a founder or an employee is not fully vested at that time, we would accelerate the vesting, right? In order for them to appreciate their percentage ownership at the time of the sale, the fully vested percentage ownership at the time of the sale. With a single trigger acceleration, the sale alone is sufficient to trigger the acceleration to the full vesting. In a double trigger acceleration, there needs to be 2 events. There needs to be a sale of the company, and then usually the employee or the founder is terminated within a particular period of time after the sale, say 1 year. Their company is acquired, and then the investor or the founder has to be improperly terminated within that 1-year period after the sale. So this was a discussion of preferred stock and the economic rights that are associated with it, other than strictly pure valuation and those formulas. And so hopefully you have a better concept of how these terms can actually be used to impact valuation and ultimately impact the economic rights that are associated with preferred stock. Until next time, venture awaits.